Today, as we all know, after 9 years, the Federal Reserve has finally raised interest rates. But have they? That is the question. I was listening to the Fed chair's speech, and I also read their release notes as well as their policy change. And it's interesting. They say they want to raise interest rates by 1/4 of a point. However, the Fed left their asset repurchase program in place. So they're not letting their balance sheet run down. They're keeping it the same, basically. So my question is how do they plan on raising interest rates? Because the Fed at this point, to get interest rates higher, you'd have to have inflation, number one, or the Fed to force rates higher via asset sales. And if they're still doing repurchases, it doesn't sound like they're doing any sales. So it sounds to me like the Fed decided to put their foot on the gas while holding the other foot down on the brake. So all that means is they're spinning wheels and making a lot of smoke. Okay, I mean, this is truly bizarre. I mean, if you're going to raise interest rates, raise interest rates. I had proposed the way the Fed should have gone about this a while back was to stop the reinvestment first, let the balance sheet run off, and then let rates rise naturally. But now they're saying they're raising rates, but they're not going to raise rates. This to me was beyond bizarre. It was obviously very dovish, and I guess you got your rate hike, kinda, maybe. I mean, it doesn't really feel like a rate hike. I'm going to go over some interesting points that the Fed made here, and I'm going to also talk about their path to normalization, if you want to call it that. So the Fed basically today conceded that there is no inflation and that they kind of just wanted to appease wanted to look a little less feckless than they've looked for the last 9 years. We all know what happened. I don't need to recap what happened in 2008 and 9 with an extraordinary contraction in credit as well as assets via a financial crash. So the Fed talked about their path to normalization here, and they see rates being 1.5% in 2016, 2.5% by 2017, and 3.25% by the end of 2018. However, they see this is their inflation path, which is mind-boggling why you'd even be discussing raising interest rates. Their goal, they've said, is 2%. They have 0.4% currently, which they see going to 1.6% next year, still below 2%. Up to 1.9% in 2017, still below 2%, and finally at 2018, 2 years from now, they're hoping that inflation is 2%. So I don't really understand why they're raising rates. I guess the Fed didn't understand why they were raising rates either, and that's why they didn't really raise rates today. You cannot raise interest rates unless you start selling assets or you have inflation. We know we have deflation because of what's been happening in commodities. And yeah, it is just a forecast. That's the whole point. Their forecasts have been wrong the entire way. They've been wrong about GDP. They've been wrong about ISM. They've been wrong about PMI. They've been wrong about durable goods. They've been wrong about oil being transitory. They started talking about the price of oil being transitory at $60. It's 37 today, for crying out loud. If that's, people, if you worked on a desk or at any firm and you said something was transitory at $60 and it was 37, you would be escorted out of the building by security and probably brought in front of a congressional hearing, for crying out loud, if you did it big enough. This is why, there is no accountability. This is why the system blew up in after 2007. The blow up really started in 2005, but this is incompetence, absolutely incompetent. I went on the record and I had said I thought Ben Bernanke was the most competent Fed chairman in history. I still believe that. I also said I thought that Janet Yellen was kind of going to be the new torchbearer and that she was very competent. I'm starting to question it a little bit. I still think she's very competent. Greenspan was one of the worst Fed. Someone asked about Greenspan. He was absolutely one of the worst Fed chairs in the entire history of the Fed. I could go into a major Fed lesson, but we don't have the time for that. I don't get commercial breaks, so I have to drink water in the broadcast. I'm sorry. Anyway, so anyhow, the story of the Fed here is this. So I'm going to go through my notes on what they said, and I'm going to interpret the jargon for you. They basically were saying that they weren't hiking because of fear. I heard a few people on TV saying if the Fed didn't hike, people would be afraid that there was something lurking. I'll tell you something. When the Titanic was sinking, they had the band playing to keep people calm, and I'm gonna stop short about the other comparison that I was gonna make with the Nazis playing music while they marched people into gas chambers, but that's a little bit too much of a stretch. But they are, I think, kind of trying to let people think things are okay when they're really not. I'm trying to phrase this. If you just take a look, let's go apples to apples. There are high yield. Their problems always start in the high yield. It's sort of the weakest link. And I wouldn't say we're in financial crisis mode yet, but we have the path to one very easily. The problem for me is that when the Fed didn't hike in September, they cited a litany of reasons. I don't really want to recap all of them, but a lot of them were this. Let's do a couple of the important ones. Oil, the transitoriness of oil, which is now lower. The strength in the dollar, which is now higher than it was then. The slowing global growth, which has slowed even more than then. Asia, which is seems to be back front and center because they're not doing so well. The list goes on. So if they weren't comfortable hiking in September, why are they comfortable hiking now when things are worse? Makes no sense. Anyway, they had a unanimous decision. I guess, when you jump, you all hold hands. I think there's that famous saying from the Civil War, we'll all hang together. We all stick together, or we'll all hang separately, or what have you. I forget the exact quote. Anyway, they see the labor market improving. I don't think so. I think that the labor market is actually worse than it's maybe ever been. There is a ton of part-timing. Companies are trying to avoid paying the Obamacare tax. We know it's a tax because of the Supreme Court. They are giving people part-time jobs. There isn't that much wage inflation, which is something the Fed has been looking at. It's like up a tick and down a tick and up. There is no real wage growth. I believe a lot of that is structural, not as cyclical as the Fed seems to think. So that to me is a really big red flag. They also cited that the labor participation rate, which just means the amount of people working, is slowly getting better. It is the worst in my lifetime since 1978. It is not improved since those lows, and it's been that way for quite a while. They keep saying that inflation is going to normalize to 2%. They said that in September, and oil has been cut substantially lower. Copper is substantially lower. You name the commodity, it is substantially lower. The only thing that isn't substantially lower yet is the U.S. stock market. So this is now their new term. Just so you know, when you turn on the TV, you're going to start at infinitum hearing gradual. And Janet Yellen discussed not being mechanical, meaning she won't raise every single meeting like Greenspan did 17 times in a row until he crashed the economy. So my guess is they're going to start raising every other meeting. I would say that the next meeting is for sure off the table because she wants markets not to believe they're going every single meeting. So it would make a lot of sense to me that they're not going to raise the next meeting, kind of just to show that they mean it that way, that they're not going to be dilettantes and go every single time. So I would say the next meeting is likely off the table. I would say maybe by March they're going to start talking tough again. We'll see. Just keep in mind, I've discussed that the fourth quarter so far has been a huge bust in terms of retail. The numbers could be rather weak, and we know we historically have weak first quarters. That could be very dangerous. I have warned that I think the Fed should really wait to see what the fourth quarter and the first quarter look like, but they didn't, or maybe they did. I mean, I don't even know what they're doing here, raising or more QE. I mean, this was an absolute abortion of a Fed policy today. anyway, gradual is the new thing, and how gradual they're going to be is going to be the new thing. We could discuss ad infinitum. Markets like the removal of uncertainty. Yeah, that's true, and yes, you got this out of the way. I do believe, though, that the market had a bit of a hesitation at first. It initially had gone down on the Fed, and I think that's because they didn't understand that they were really disguised QE in a rate hike. They're doing more QE, these guys. I mean, they're not raising rates. They have their foot on the brake and they're pushing the gas. They just made a little smoke and got people excited. You know, when you do wheelies, that's what they're doing. Burnouts or whatever. It's like Fast and the Furious with these guys. So I was waiting for Vin Diesel to give the statement, for crying out loud. So that's that. The economy is expanding at a moderate pace. They always say that. They don't want to say that the theater is burning. International developments, they're being mindful of, so they gave a nod to that. I think that's coming more back into the lexicon. They had taken a lot of criticism from some of the hawks the last time, but it is coming back into vogue. I do think that the lower price of energy is probably going to start helping growth in Europe and in Asia, so let's see how that goes. But they were a little concerned about that. They mentioned the jobs and the inflation, which we know they're a country mile away from hitting. We've discussed this, the lower level of normalization. I said even before the Fed leak this summer, you know, the staff members, their interns or whatever, they said that it was going to be about 3.5%, and it was 3.5%. So that is historically low. Usually they jack rates to between 5 and usually 6%, and that's where you start getting the crashes because the bond equivalent yields start becoming less attractive. I told you the QE Lite they mentioned the reinvestment. They're going to go at a moderate pace. The DOTS forecasts, not for next year, but for 2017 and 2018 came down. That just means the expectations for rate hikes and expectations for further Fed action. We mentioned the labor participation rate. They talked about cyclical weakness. What they didn't talk about, and I've only heard Janet Yellen talk about this briefly over the summer, is structural unemployment, which I believe we have cyclical with structural, and I believe it or not, I think it's hurt a lot of blue-collar workers, and I think it's going to start hitting the white-collar ones soon, with you know, drones and God knows when they start cloning people. That's going to be, you know, we all know how that ended with Terminator. Although the Terminator, that we might not be, you know, have our bones crushed like they did in that, but we might be crushed into unemployment lines. It's a good thing McDonald's is doing all-day breakfast because that crowd really needs catering to. And I'm not even being flip. I really believe that. Wage growth isn't good. They talked about the GDP of 2.25%. You know, I have to tell you is that level of GDP is very vulnerable, particularly to shocks. If we have terrorism, you know, we just had the school system in California shut down, in LA shut down the other day. We had that San Bernardino shooting. These are not big deals, of course. I mean, it's a terrible, tragic loss of human life, but it's not a 9/11 event. Something like that could cause a recession very, very quickly. That shock risk is still out there. Foreign growth, they talked about the dollar. They talked about that is the big problem. The good news is that the dollar is sort of just hovering around here. The bad news is that if it gets through 100, there's a lot of room to the upside, and if that happens, then we're going to start getting contractions in earnings, and we're going to have to start dealing with lower stock prices. They talked about domestic spending. I wrote down it's basically running on empty. You know, they were talking about, they keep highlighting the auto sales and real estate. The bad news is that all the banks came out after the interest rate hike, and by the way, the saver gets it, you know, in the kisser again. They decided to raise the mortgage rates. They're now up from 3.25% to 3.5%. Floating rates are going to get jacked. And they decided that they are not going to raise the rate for depositors. So congratulations. Your banks are benefiting now from the rate hikes, not the depositors. That should be good for bank stocks, but I've mentioned this before. The earnings I guess, path for banks ain't what they used to be. It's not your father's Oldsmobile, so to speak. In this instance, it's their earnings have been impaired because of financial regulations. They're really just glorified savings and loans, and they take money for credit cards and things like that. But I think the better play are the insurers, like the MetLifes, the Travelers. I think those are better bets. Those guys really print a lot of money, and higher rates will be great for them. They talked about the inflation. We went over this transitory garbage. Anyway, the good news is I've said that if the Fed starts raising interest rates, PE multiples need to contract. The good news is they're not really raising rates. They're doing more QE. So as long as that happens, you can kind of keep a higher than normal PE multiple. So that's why you saw some of the FANG stocks rally. You had Apple, which I said, by the way, was key. You need to take, AIG is another one. I like that one. I like it on dips. I had said the key to the market today was Apple. Once it finally got and held green, really was when things took off. What are the other ones? Yeah, Facebook was fairly strong today. Amazon. That one's been really wild, right? It had a false breakdown, and then yesterday it kind of looked above and failed below range. Now today back up above range. That thing's like a Mexican jumping bean. Amazon, Google, was strong. That had been weak the other day. And then Netflix also, was another one that kind of held in there. I want to just talk about one thing that had been really concerning me. I don't know that ship is 100% righted yet, but it's a good sign. Yesterday, the SPY had put in a much stronger performance than the NASDAQ. You had a lot of weakness in the Qs. I think that's because people were worried that we were going to get a real rate hike today instead of the fake rate hike that we got. So you had an outside day today in the Qs. It held the 50 and closed higher above the 20. To me, it's still looking rather strong. It basically held the tail end of the consolidation range and now looks like it wants to re-challenge the highs. Great news for longs. I believe that is going to be positive. I believe that the rate, like I said, as long as rates stay low, PE multiples will remain high. That is the key. Keep an eye on TLT. By the way, if you're, I'm going to give a little bit of a hint. I did a new I'm starting new 15-second broadcasts. I'm doing it on my Instagram account. I posted a little bit on there today. It's Justin Pulitzer Trades. I'm going to try and start doing those every day or every other day, these little 15-minute snippets. I'm a little stiff still on them, but I'm getting the hang of it. They're going to get better. It's hard to hit, fitting things into 15 seconds. I'm used to being on here with you guys for a half hour or an hour. So just follow me on there. I think you're going to find some of that stuff really interesting. I'm going to try and talk about what the market is keying off of every day. I'm going to do a little 15-second snippet in the things to watch day to day. You get a lot, in the media, they key in on this and that, and it's usually the wrong thing. I'm going to give people what really the market is keying on and focusing in on that day. So the good news is that TLT was a little weird today. It had a little bit of a dip. It had a bit of a rally. It stalled out at the gap fill, and it didn't close particularly strong. But I've said for a while it just can't be in crash mode. If TLT is in crash mode, you have PE multiple contraction. If TLT stays stable, you can keep a decent PE, and if it rallies, then you have multiple expansion. I know that sounds crazy, but that is how it is, believe it or not. So bad TLT, multiple contraction. Good TLT, multiple expansion. Flat TLT, multiple stagnation. Drifting, good. good, medium to good. I will say that we are below the 123.15, which is the 2009 crash high, which you need to have in play for still higher. It is just like in consolidation mode. If you start, I believe we're just in a consolidation range. If you start breaking the 118 to 117, we're going to have to start reevaluating, and then we're going to have to really talk about rates potentially having another leg. Let's talk about some of the ones you guys want to talk about. Solar City was the first one. Wow, that was off to the races. That is a heavily, heavily shorted stock. and it got some good news today. The Congress agreed. There was a big compromise. The Republicans got to now export our natural resources. I will say this: I am a lifelong Republican, and I happen to very much disagree with this policy. Oil and natural gas are low right now. They will not be forever. And I believe that we should be keeping those natural resources here. That isn't what happened. We are now going to export them. I think that that'll be good. I will say this, though. That will be good to take a little power away from Putin and give our allies a little bit of some breathing room with regard to policy. So that I do agree. That part I do agree with. I think it could be done strategically for that purposes, but not in general. But it is being done in general. Anyway, the compromise for that, the Democrats got to fund their make-believe of solar and wind and all of that. They got it. The subsidy was renewed, and you got the whoosh up in stocks like Solar City. So they are now going to be funded for a while. I guess with the climate change accord, this was obvious that it was coming. I don't know why this was such a shock to anybody. The good news for Solar City is it broke the downtrend. I had been talking about 52s today on the stream, and we got 53s. We'll have to see if that can hold. But yes, all of these. Sun, I guess they figure Sun is hugely levered. I guess they also recently sold some assets. I think that it's just that they figure it's not going to be a zero. I don't know how much value there is in the equity. Maybe it gets back to 10 or 11. That would be great. But I don't really see where that thing is going longer term. But yeah, you take a heavily shorted stock, you get some good news, and you get the whoosh that you had in Solar City. I will say that this has moved a lot really fast. The pattern now is broken, actually, quite broken, which is good for the bulls. You had lower lows. Now you are making higher highs. What I'd like to see, though, here, before everyone gets excited and they all want to pile in, they hated it at 24, but now have to own it $30 higher. You want to see it pull back. You want to see it make a higher low to confirm the pattern change. This is a break. It's not a confirmation. The confirmation comes when you get a pullback, and then this high from this leg gets taken out. That would mean the pattern has reversed. At the very least, I want to see a pullback before I, go foray chasing into these things. USO, we're going to bounce around a little. Still really weak. Fed rate hikes aren't going to help commodities. I will say I believe the problem that is happening with oil is that prices tend to overshoot. You had a lot of production that went online here in the United States, and the Saudis are looking to take market share. They're looking to bury these companies so they keep pumping and pumping. This price is not sustainable for any of these countries' budgets for very long. I've heard that the Saudis can pull oil out of the ground for anywhere from between $10 to $20. So they may try to take it down to that cost. I don't really think that is going to be the case. I've said for a while I think oil is trying to find a bottom. I don't know where it will be. I said somewhere between 37 and 33. I think I had said 33 or 32. I'd have to, let me see, /CL. 33.20, somewhere between 37 and 33.20. We're basically in that range now trying. The good news for energy is that oil made new lows and that Exxon and Chevron and the big boys didn't. Those will bottom likely before oil does. So that is a good news. I had been playing that short. I talked about how I was playing Exxon. I had been playing Exxon long, then I played it short, and then I played it long again, and now I'm out. So I am looking to reload on that, though, into any weakness, and I will explain how I did that. I did a put ratio. I forget what the numbers were. Let me see. I might still have. I think I have one on. I think I have some on an account. Let me see. One position still. Yeah, I did the 75-73 put ratio, and I forgot I had it in one of my accounts, and I didn't close that. It'll just go out worthless, whatever. I made a good amount on other ones. So what I did there was when it came down, I closed the spread. So I did it, let's say, 1 by 2. I had long one of the 75s, short 2 times the 73s. So when it came in, I closed
the one-to-one part, and I left the extra short 73s. It rallied, and then I closed the 73s. So I was I like to close it at the time, but I was looking for a bounce, and I decided to play a little more directionally there, and the gamble paid off, and it paid off quite well, actually. So that's that with Exxon. So my story with Exxon, that is the best of the integrateds. It wasn't particularly strong today with regard to Chevron. That Chevron CEO, by the way, is like my new bromance. I love what that guy had to say. He said his like number one priority was to maintain the dividend. They'll cut CapEx, they'll cut everything before they cut that dividend. I like when dividends are sacred cows. So I think Chevron on dips is probably, let's start with Chevron, but I'll get into Exxon since I'm talking Chevron. Chevron, as long as it holds, although it's up a lot now, it did kind of come back down to kind of retest. It didn't fully get there. 81.20 was the breakout. It was starting to look like a head and shoulders, but now the shoulders are violated, so that pattern is negated. Let me tell you, everyone talks about how powerful a head and shoulders pattern is. A failed head and shoulders is an absolute barn burner to the upside. So this thing could really take off and get back to 100 quicker than people might realize. I like Chevron on dips. The gap here that needs to be filled, I guess, was 89, so maybe sell some out of the money puts if you want to get in a little lower. Unfortunately, the time to have done that was before the Fed, when IV was still high. I had talked about on the stream, the play for the Fed was an IV crush, and man, did you get it today. I'll talk about the VIX in a little bit, though. With regard to Exxon, Exxon got the 61.8. It bounced. It got back to the 61.8 and then took off. I drew a regression price line and a downtrend. We are basically right there. It stalled there yesterday. Today was kind of an inside day. We sort of held a little bit okay. If you could take out the 2-day high, then I'm on board for if you want to chase a little higher for Exxon. Really needs to clear the double highs. 79.61 over there, I would say, is a right or right out long with a stop on a close below today's low. If you want to be a big boy, a big girl, below 78 is GTFO. Okay. Someone was asking about gold. It was really interesting today. I'll give you a little bit of a tip I use. If you're trying to predict where gold is going to go, look at silver on Fed days. Silver usually leads the way. Gold and silver were strong today going into the Fed. It was interesting. I guess they knew that we were going to get a fake rate hike also today. So I guess they kind of sniffed that out. Maybe it's trying to find a bottom. This is a really hard asset to call any particular bottom in. I have been looking for 96.35. That is the big 61.8 Fibonacci retracement from the beginning of the entire run. We're really close. It would be a really huge shame if we didn't get there. But I've been looking really, frankly, for for gold to bottom between 100.44, which was the 2008 peak, I believe. The peak in 2008 before the correction, and then the real liftoff point. And the 96.35. So we got really, really close. So any more weakness into there, I'd be probably looking for a right or right out type of play. Silver, let's take a look at silver. Is kind of just hanging around some of these lows here, not doing very much. The bad news is that silver could go down, and SLV could retest the $8.45. Below 14, it's a little bit vulnerable, but it's kind of just hovering around there. Maybe it's just consolidating and building a base. We'll have to see. I wouldn't be shorting it here either. I'd be waiting for a rally if you're bearish. IBB, this is a really simple one. There are double tops, and those are 41.25 and it's a little bit higher. 41.25 to 42.89. If you could take out those two highs, it is off to the races. Anything below there is still basically in this chop consolidation range between the lower 300s and the mid 300s. Kind of just is what it is. Twitter, I think Twitter has dealt with a lot of tax loss selling. It was good news that they got Periscope in there as one of their as the iPhone app of the year, actually, for the 2005 iPhone app of the year. Problem with Twitter is people just don't have faith in them. They need to start showing monthly average user growth until they can be a growth. They have a growth multiple. The stock is still not cheap, believe it or not. It's, I think, too expensive for a takeout. I think that they're trying. It looks like they're trying to put in some lows here. Maybe the stock will get some kind of a rally, but they really need to show that they can grow. That's really what it comes down to. Apple. Someone asked about Apple. So Apple today, I talked about it holding trend. It stopped just shy of there. The 109 is a key level, and you got what you should have got, a responsive bounce back up to 111s. Which is a key level. You're starting to get some hammers down here. I'd like to see the 3-day high taken out here, the 112.80. Then maybe you see the 115s and higher. But the problem with Apple for me is that we're making lower highs and lower lows on this leg. So it's really going to just be a game of pinging levels until you get a breakout or a breakdown. The relative weakness has been startling in this stock, and I am on major caution mode with regard to this stock. So I think that you'll have a better opportunity to play this via short premium as you get closer to their earnings report, when the IV starts getting jacked. Someone asked about Eli Lilly, not one I cover very often, but they had what I thought was to be a professional gap a few sessions ago. It wound up being kind of a flash in the pan, and then it came back really quickly, then ripped up really quickly. This is just all over the place with really sharp moves. I guess it's buy the dips and sell the rips in that name. It is above the downtrend line. There have been moves above it that are kind of a little bit unsustainable. I have a bit of a channel. Whoever asked me about that, if you tweet me about it, I'll send you my chart. I think that'll help you a little bit more than this discussion might, because it's kind of a visual, it's a real visual one that you need to see. So let's move on. I discussed the dollar. If it's dangerously close to this 100 level, and once it gets through there, we are off to the races. That's when you get your real. That's when you'll get your real Fed panic. Once the dollar takes off. They cite that as a concern of theirs. I mean, I just don't, with the weakness that we have had in the economy and the strength in the dollar, I just don't understand what the Fed is why they're even discussing rate hikes. They should be discussing more QE, but I guess they're kind of doing it, aren't they? VIX has acted very well technically. You got your 25, you got your 22s, you got your 25s. It had a look above and closed below, and I discussed that in the weekend video that I didn't think we had as much crash risk for Monday because we did close below 25. I talked about on 8/21 when we did have the big crash, really the crash came. We had a very nasty day that day, but it came on the 24th. On the 21st, you had closed well above 25. You don't have crash risk in my view unless there's some type of an event that you can't predict, but the predictable way to know you would have it is if we closed 25 or above. It was unsustainable. We got 22s, it bounced. It got 20s, it bounced. And now we are basically down to the kind of tail line of the upper distribution of support between 1757 and 1785. We closed at 1786. So we're not out of the woods yet with volatility, and a potential there could be for a bounce back up to 20 if they want to retest some levels that I'm about to discuss in SPY. Not yet. In a minute I will. I discussed TLT already. Someone asked about Netflix. So Netflix has really been acting very toppy, actually. I had discussed that I thought we would get back to 115. We did. We got the big bounce. Now we're kind of consolidating here. If you can take out those double tops, you'll be off to 150, 151. Until there, I think you're kind of going to be in consolidation limbo here. A nice way to play this with the stochastics rolling over might be to sell out of the money strangles, iron condors, or if you're bullish, just sell some out of the money puts on weakness. But this to me looks like it is going to consolidate a little. I'm still not convinced that the worst of this is over just yet. Let's see. If you could take out the 2-day high from today and yesterday, you'll probably have a little bit more of a push. Maybe you'll even get to 126. Let's talk about SPY, right? Enough of this messing around. Let's get to the meat of the situation. So we're expecting a $3.32 move between the close today and I guess Friday expiration. So we closed today. Where did we close? 208. Pretty solid close. Although we were down a little bit after hours, doesn't surprise me. There was some MOC that was to the sell side. So that would take you up to 211, which is basically the 2100, which is where the real resistance has been, or down to 205. Maybe if you come down, that number will probably increase, so it would probably be 204, 205, which, as we know, is the tail line support of the pre-collapse upper distribution. The real line in the sand, as I've been discussing, is 201.90. When we had the dip below, it was a look below and fail, and the bar closed above 201.90 on that hammer, and then that's what caused the rally. It's really just been, so we had a fake look below. The bad news is it was a look below, so it's a lower low than the prior swing low, and it's off a lower high, so things are a little bit iffy, but I would say with the Fed out of the way, if the bulls can hold, and here's the key level, this is why you guys watch me for the hyper accurate SPY levels. So you have a couple of really interesting things today. You have a confluence of the 50 and the 200-day moving average, and the good news is the 50 is about to cross through the 200. The golden cross, bullish, right? Maybe. The interesting level to me that I see that I see when I look at this is that level coincides perfectly with the bottom of today's body of our candle. That is the must hold in my opinion. If you start getting into the tail, it's not as stable ground. So as crazy as this sounds and as cliche as it sounds, you gotta hold the 50. You gotta hold the 50 MA. It has this coinciding events. The 50 is at 206.30. The bottom of the candle is a little bit higher. It's 206.36. My guess is that's going to be equal to that maybe tomorrow. So if you do get a pullback and a retracement into that area, you really need to hold that level. Let me look on the 5-minute of SPY. The breakout today was over the high of day, which was 206.78. I want to just talk about why you had the morning weakness today. You had basically the last 2 days you've had people long, and the prior two and the same. Both regular trading hours and pre-market or overnight or whatever were all long. So you had a lot of people coming in very heavily long today to the Fed, which I believed could have been a recipe for disaster. The good news is that we sold off enough of it and kind of tested some VWAP and did some stuff we needed to do to enable the ability to have the rally today. The bad news is I don't know if yet if this rally is going to hold. So let's see if that area holds. Like I said, the breakout here, the wick of that was 206.76, and I just told you that the 206.36 was where the body begins. If you start losing that area, it starts getting iffy. What was VWAP today? VWAP was oddly right there, 206.74. So I would not be surprised to see that retested. That area within that 30 cents or so needs to hold. If we get below there, we're going to see the 204, 205. And if we lose that again, I think it's lights out for this tape for the rest of the year. If that area can hold, we can continue to rally. I've discussed below 204, 205 is very vulnerable to 202s. Below 202s, it's 197s maybe 200s to 197s. We could hold this level that I'm talking about here, this roughly 207. So let's say it's 206.36 to 207. If you can hold that area, we'll see the 210s, the 211s, and maybe even all-time highs. You need to be over 210, hold it, and comfortable for all-time highs. that would be something. The ideal scenario would be some type of blow-off situation that we get into the end of the year in first quarter, and then you could short the piss out of it in March, or maybe even sooner, depending on how maybe for a multi-year move lower when the Fed actually starts raising rates. Anyhow, that's my story. I'm sticking to it. If you're not following my new Instagram account, I'm going to do these 15-second bites every day, or at least until I get sick of them. Or at least until I don't, I'm kind of piloting it. It's Justin Pulitzer Trades. Follow me on there. I think you're going to find those things really, really interesting. I'm going to talk about Instaballs. I love that. I'm going to talk about what I think what the market is keying off that particular day. Usually I talk about it being oil or the dollar or Apple in this instance I had talked about today being really key. I will start posting those. I'm going to try and do them daily. I think you're going to like them. Anyhow, that's it. If you enjoyed this broadcast, if you caught part of it and want to see the whole thing again, it's going to be on my YouTube channel, which is Justin Pulitzer Trades on YouTube. Follow me on Twitter. It's at Justin Pulitzer. Anyhow, that's my story. I'm sticking to it. I will be posting 6 seconds is way too short. We're not going to Vine. We're Instagram, and that's it. Anyway, that's my story. I'm sticking to it. Let's see if those levels hold tomorrow. I wouldn't be surprised if they get challenged. And I will see you on Sunday with my weekend video review.